So I bought silver differently than I buy gold. I buy gold as a savings asset. I bought silver as a speculative asset. I'm not one of those guys who immediately after I sold it, it didn't go down. It went up to 100. I couldn't care less. I made lots of money in the middle, and I was happy about it. If the silver traded sideways, the silver stocks could still go up by 50% in the course of a year. But it wouldn't surprise me if I didn't sell my gold now for another 10 years. It's a savings asset. In fact, some of the money that I put in my pocket as a consequence of selling my silver, I moved into gold because I consider it savings.
If I were to tell you, hey, silver is going to fall, let's say I have a crystal ball, silver is going to fall tomorrow, 30%, it's going to be the biggest single day drop since 1980. What would you do with that information? Sold, I think, more than 50% of your physical silver. What have you done since the end of January? Have you bought back any of that silver?
Put about half the money into silver stocks.
Gold at $5,000. Producers are printing cash. Explorers are finding it easier to obtain capital. Where would you prefer to go?
Now I'm moving back into the junior end of the market.
Rick has made an extraordinarily correct call on my show just a few weeks ago. End of January, we had him at the VRIC Vancouver Resource Investment Conference. Link down below to check out the full interview where he said right before, a few days before the big crash in gold and silver, that he has already sold or taken profits in a significant part of his silver holdings. And shortly after we aired that, silver went down 30% in a day. So we're going to find out what Rick is doing now. Welcome back to the show, Rick. Good to see you.
Pleasure to be back. Thank you for that kind introduction.
Well, congratulations on giving us a fair warning. And like I mentioned in the beginning and what people can see, that was a rather prescient call. You were at the VRIC warning people of an imminent correction, which is why you took profits. You didn't sell everything. You took profits in some of your holdings. And immediately after that aired, I'm not saying it was because of you, I'm just saying immediately after that aired, we had a big correction in all the metals, by the way. Copper, palladium, platinum, gold, silver, all moved in the same direction shortly after, down, troughed the same day, and then moved up. Before we get into what's next, let me just ask, how did you know, or at least suspected? Nobody knows for sure, but how did you suspect that the metals have already run up beyond what was reasonable, which prompted you to take profits?
A 30% one-day collapse isn't random volatility. It's leverage unwinding in plain sight. As Rick Rule points out here, he trimmed silver before the drop, not because he predicted a date, but because price had detached from reason. When copper, palladium, platinum, gold, and silver all plunge together, and that's liquidity stress, not just metal weakness. The part most investors miss is positioning. When everyone crowds the same trade, the exit door gets very small, very fast. Next, Rick Rule discusses what signaled the move was stretched in the first place.
In fairness, David, I didn't. What I know is that when you see a parabolic chart, what Canadians would call a hockey stick chart, that the backside of that stick is just as steep as the front, but it's a lot less fun. And so when I saw silver melt up, it was pretty clear to me that at some point in time it would melt down. But I'm not a trader. What actually happened for me in that trade, and I think you and I talked about it at the time, was that I bought silver differently than I buy gold. I buy gold as a savings asset. I bought silver as a speculative asset. I bought silver when it was about $20 an ounce, and I bought it because it was roundly aided. And I thought, if the hate dissipated, that the silver price would go up. And I bought it thinking, too, that a precious metals bull market was inevitable. And at some point in time in the bull market leadership would change from gold to silver. When those two things happened, that silver became inappropriate in my speculative account. And I needed to say, what is the best use of capital in my speculative account? The reasons why I bought the silver are no longer true. And what I did, 48 hours worth of soul searching.
Parabolic charts don't predict timing. They expose psychology. As Rick Rule points out here, silver wasn't sold because of fear, but because the original thesis expired. He bought at $20 when sentiment was toxic, and leadership favored gold. But once silver became the crowd favorite, the risk-reward flipped. The distinction between savings asset and speculative asset is portfolio architecture most retail investors ignore. When leadership rotates in a bull cycle, capital discipline matters more than conviction. Next, Rick Rule talks about where that speculative capital was redeployed.
What I discovered in my thought exercise was that if the silver price went up, silver stocks would do at least as well, but probably better than silver. Remarkably, if silver traded sideways from $75 for a year, by definition, I wouldn't make any more money on my silver. And interestingly, because the silver stocks, the high-quality silver stocks, were being valued on Bay Street with a $40 or $45 price assumption, if the silver traded sideways, the silver stocks could still go up by 50% in the course of a year. And more remarkable still, at least arithmetically, getting away from the narrative, if the silver price declined from 75 to 50, the silver stocks, perhaps not their market price, but rather their value, wouldn't decline at all. That meant that for me, allocating 50% of the money I had in physical silver into silver stocks instead was a better use of my speculative capital. So I would love to say that I was a spectacular trader. What actually happened is that I was an honest investor, at least honest with myself. The reason that I own the silver ceased to be true. So I sold the silver. I am not one, David, in my defense, who has an iota of fear of missing out.
Sometimes a smarter move isn't selling the theme, it's upgrading the vehicle. As Rick Rule points out here, if silver stayed at $75, physical holders earned nothing new, but quality miners priced for $40 to $45 assumptions had valuation torque. That's asymmetry, upside participation, limited fundamental downside, even if spot pulled back to $50. Most investors chase price momentum instead of scenario math, ignoring how equities can outperform metal in sideways markets. Discipline means reallocating when probabilities shift, not when headlines scream. Next, Rick Rule unravels why fear of missing out never drives his decisions.
I'm not one of those guys who, immediately after I sold it, it didn't go down. It went up to 100. I couldn't care less. I made lots of money in the middle, and I was happy about it. My own discipline is that when the reason to own something goes away, the asset goes away. I redeploy the capital. And that's precisely what happened to me in the silver trade.
Let's just look in the rear view mirror for a few more minutes now. I like this exercise. We had talked about silver at the VRIC when I interviewed you, but were you equally cautious on gold? And I ask this because gold and silver fell on the same day, different orders of magnitude percentage-wise, but both big drawdowns in a single day. Silver had the biggest single day drawdown since 1980, and gold for at least, I can't remember how many years, but it was many. I believe all the way back to 2011. And so these were major, major corrections by anyone's measure. But did you have an inkling of suspicion the same thing would have happened to gold as well?
I had no care because for me, gold is a savings asset. It's an insurance asset. Silver was a speculative asset.
The real edge isn't calling the top. It's not needing to. As Rick Rule points out here, once the thesis changes, the asset leaves the portfolio, even if price keeps running. A 30% one-day drop in silver and the largest gold decline since 2011 signal systemic positioning stress, not isolated weakness. But separating gold as insurance from silver as speculation reframes risk management entirely. One protects purchasing power, the other seeks upside. That distinction is portfolio construction, not emotion. Next, Rick Rule discusses why gold's role is fundamentally different.
It is, well, at some point in time, because gold's a source of liquidity, I may sell some. I sold in 2009, 2010, because there were other asset classes that seemed more deserving. In other words, I use it as a source of liquidity. But it wouldn't surprise me if I didn't sell my gold now for another 10 years.
Yes.
It's a savings asset. In fact, some of the money that I put in my pocket as a consequence of selling my silver, I moved into gold because I consider it savings. I need to say too, David, as you can tell by looking at me, I've done this for a very long time. And the set of circumstances, the pullback that we saw, is one of many that we will see in the future. In the decade of the 70s, my formative years, the gold price ran 26-fold. But at least 4 times that I can remember in the decade of the 70s, the gold price fell by 20% or more. In 1975, the gold price fell by 50% without derailing the gold bull market. So I consider the crash that we just saw to be noise, not music. Now, certainly, anytime I see a parabolic chart, I'm inclined to take advantage of that, because I have learned that even if the backside is of less duration or less magnitude than the front side, it is equally steep.
Yeah.
Volatility feels catastrophic in the moment, but history rarely agrees. As Rick Rule points out here, during the 1970s, gold ran 26-fold, yet suffered multiple 20% drawdowns and even a 50% drop in 1975, without ending the bull cycle. That context matters for investors panicking over a sharp correction today. Gold as liquidity and long-term savings means tolerating violent swings while watching macro trends like deficits or monetary expansion. Short-term charts scream, long-term purchasing power whispers. Next, Rick Rule talks about why experience changes how you react to these pullbacks.
Rewind the clock to... I'm sorry, please go ahead.
No, I just, that's something that younger speculators don't understand as well. You have to have experienced yourself 30 or 40 times before that religion gets ingrained, which I have.
I'd rather not experience this 30 times myself, but that's why we learn from you, Rick, and not through our own mistakes. Rick, rewind the clock, please, back to February 2nd. What were you doing on that day, which is when gold and silver troughed? Well, actually, silver rebounded and then went down even more on February 5th. But the big correction, the big single day drop happened on February 2nd. Did you want to, at the time, buy back some of your position? What was going on through your head there?
On February 2nd, I was celebrating my birthday with a select group of friends in Nicaragua.
Happy
and I was completely unconcerned with the gold market. I'm not somebody... I don't want this to seem like a sexist reference. I'm not somebody that's particularly good at observing tops and bottoms. And I'm really unconcerned. I'm not any longer a trader. I am a speculator. I am an investor.
The quiet truth is that experience dulls panic faster than any chart pattern ever could. As Rick Rule points out here, after 30 or 40 cycles, a single brutal down day feels less like catastrophe and more like tuition already paid. February 2nd's drop, the sharpest in years, didn't trigger action because his strategy wasn't built around timing tops. That's the gap most investors ignore. Traders react, allocators endure. Emotional detachment is a competitive advantage when volatility spikes. Next, Rick Rule talks about whether foreknowledge would even change his behavior.
But trying to kid myself that I would have the ability to call anything like a bottom is silly.
But if I were to tell you, Rick, I mean, we're looking at in hindsight, but if I were to tell you, hey, silver is going to fall, let's say I have a crystal ball, silver is going to fall tomorrow, 30%, it's going to be the biggest single day drop since 1980. What would you do with that information, assuming you knew in advance?
If you were talking to Rick Rule, nothing, because okay. I sold my silver. It used up its purpose. It fell to a level that already exceeded my greed. I bought it at 20, thinking it will go to 50. It would need to fall really, really, really substantially for it to be able to occupy mind share in the speculative part of my portfolio. It is, for me, a different asset than gold, and it serves a different purpose in my portfolio. Other people feel differently, and they need to act differently.
Well, you had said in my January interview that you sold, I think, more than 50% of your physical silver. What have you done since the end of January? Have you bought back any of that silver?
No,
No. Okay.
no. I put about half the money into silver stocks, mostly successfully, but one one spectacularly unsuccessfully. I bought some physical gold, which I bought for liquidity. I bought for savings. I took some money off the table. I do that when I speculate. If I have a really successful speculation, I get some of the money out of harm's way, which I did. And I used a bit of the money to increase my holdings in oil and gas equities.
Even perfect information is useless if it doesn't fit your mandate. As Rick Rule points out here, knowing silver would drop 30% wouldn't matter because the position had already fulfilled its purpose. He separated greed targets from portfolio roles. $20 to $50 was the plan, and once exceeded, capital rotated. There's capital allocation discipline most investors lack, especially after extreme moves like the biggest one-day drop since 1980. Notice the shift into stocks, gold, and energy, diversification, not reaction. Next, Rick Rule discusses how investor effort changes opportunity selection.
Gold at $5,000, producers are printing cash, explorers are finding it easier to obtain capital. Where would you prefer to go?
David, at some point, that's a trick question because it depends on who the investor is, what their time frame is, and how hard they're willing to work. I myself, for some substantial time, believed that I had better opportunity on the big end of the market, in the beta, because early in a bull market, just capturing the beta gives you great returns without much risk. And the alpha got ahead of itself. You'll recall in October, I sold 25% of my juniors. For the same reason I sold my silver. They gave me too much too quick. Now I'm moving back into the junior end of the market. But I'm doing it as a guy with 50 years experience in the market that spends full time in the market. Most of your viewers have lives. They have kids or grandkids. They have jobs. They like to garden or fish. For people who aren't willing to do the work, they need to de-risk their portfolios. They need to buy the beta. They need to forget the alpha. Forget about the fact that when you're walking down Vancouver, you bump into somebody who owned Amalgamated moves past your minds and accidentally got a 10-to-1 return.
The myth of easy 10-to-1 returns hides the labor behind them. As Rick Rule points out here, alpha isn't free. It demands time, proximity, and relentless due diligence, especially in junior resource stocks. When gold flirts with $5,000, producers generate cash flow, but juniors can detach from fundamentals quickly, as seen in October when he trimmed 25%. Most retail investors don't have the bandwidth to vet management teams or capital structures. Beta often wins quietly, while alpha burns capital loudly. Next, Rick Rule unravels the real odds behind retirement savings discipline.
You need to think about the probability that you'll get that same return not doing any work. And the probability of that is zero. So unless you're willing to exercise the advantage of living in Vancouver, visiting the companies personally, reading the annual reports, the quarterly reports, the proxies, err to the big end of the market. Think that a 401k or an RRSP or an IRA is the only form of savings, not the only, but is one of the best forms of savings to shield your retirement from government theft, which is to say tax. The biggest risk that you face, other than making investment mistakes, is the sure sense that if you're prudent enough to save some money, that the government will do their best to take it. And I am in favor of any kind of savings, provided that the savings are invested intelligently, and provided that to the extent you can, you shield the savings from tax. And when I say invested intelligently, I really do mean prudently and for the long term, not traded. David, this isn't a question you asked me, but I'm going to answer it anyway.
Yeah, please.
Fidelity Investments did a study.
The uncomfortable math is that effort compounds just like capital. As Rick Rule points out here, the probability of earning outsized returns without doing the work is effectively zero. For most investors, tax-advantaged vehicles like 401ks and IRAs aren't exciting, but they quietly protect long-term compounding from erosion. The bigger unseen risk isn't market volatility, it's taxation and poor discipline. Shielding gains and investing prudently often beats chasing speculative headlines. Next, Rick Rule discusses what large-scale investor data reveals about long-term performance.
Fidelity handles millions of investors worldwide, tens of millions of investors, and they sliced and diced their investor universe, ethnicity, age, race, sex, income, all that kind of stuff, trying to figure out how to market to various subsets of investors and how to serve them better. And they found that the best performing subset of investors in the Fidelity universe over 10 years were estates. They were dead people who didn't chase fads, didn't pay capital gains tax, and invested for the long term. And so in addition to the fact that you have to save, I think you have to invest prudently, not jump from fad to fad to fad. But whatever you do, you have to save. If you think today that your retirement income will be sufficient, depending on your age, to fund your lifestyle, what you need to do is factor in the arithmetic of a 75% depreciation in the purchasing power of your investments. And then say, is the yield that I expect to get on my investments 10 years from now sufficient to fund my retirement with a 75% deterioration in purchasing power? Yes or no? If the answer is no, you need to adjust your rate of savings and you need to adjust your lifestyle expectations. And those are very, very, very hard decisions, but you need to do them now.
The highest performing investors over a decade were the ones who did absolutely nothing. As Rick Rule points out here, Fidelity's data showed estates, accounts untouched by emotion, outperformed active traders who chased trends. I say that's a brutal indictment of overtrading, especially in cycles like 2020 to 2023, when liquidity swings distorted behavior. A 75% purchasing power erosion over time isn't dramatic rhetoric. It's inflation math compounded. The question becomes whether portfolio yield can outpace currency decline. Next, Rick Rule talks about why macro conditions suggest that erosion may worsen.
Well, if you just consider the global monetary conditions today and speculate as to whether or not the deterioration of purchasing power will either accelerate or decelerate, meaning we'll get a more stable economy in the future, stable inflation, which side would you err on?
Pretty clearly, a worsening of the circumstance. The arithmetic of Western democracies, the fiscal arithmetic of Western democracies is lousy. It's in fact unsustainable. At some point in time, you and I can talk about that at length. But suffice it to say, it's unsustainable. The only thing that I can think of that would change it for the positive would be really dramatic breakthroughs in technology. Perhaps AI is that dramatic breakthrough. But AI, while it could benefit society as a whole, will be fairly difficult on the people it replaces.
The real risk isn't a market crash. It's slow currency decay disguised as stability. As Rick Rule points out here, Western fiscal arithmetic is structurally unsustainable, and absent radical productivity breakthroughs, purchasing power erosion likely accelerates. Governments continue deficit spending while central banks juggle rate policy, hoping growth offsets debt loads. AI may boost output, but it also displaces labor, creating social and political strain that markets tend to underestimate. Investors betting on a calm inflation glide path may be ignoring deeper imbalances.